Is the global financial order at risk? The impact of Japan and China's massive U.S. bonds sell-off for decades. U.S. Treasury bonds have been the backbone of the global financial system. Central banks and investors worldwide have bought trillions of dollars worth of these bonds, viewing them as a safe haven. Among the biggest players in this system have been the economic powerhouses of USA, Japan, and China. Both nations have held massive reserves of U.S. bonds, not only as a means of stabilizing their own economies, but also as a way to finance the American government. However, recent reports indicate a dramatic shift in this long-standing trend. Allegations suggest that Japan and China have sold nearly 45% of their U.S. bond holdings, sending shockwaves through financial markets. But what does this really mean? Is this a coordinated effort between two rival nations to weaken the U.S. economy? Or is it simply a response to shifting economic and geopolitical realities? The role of U.S. Treasuries in global finance. U.S. Treasury bonds serve as one of the main instruments the U.S. government uses to cover budget deficits and finance large-scale projects. The appeal of these bonds lies in their perceived safety, backed by the strength of the U.S. economy and the dollar's status as the world's reserve currency. Over the years, particularly following the 2008 financial crisis, public debt has soared, with the Treasury Department relying on foreign buyers, especially Japan and China, to absorb large portions of its bond issuances. For Japan and China, holding U.S. bonds has historically provided two major advantages. First, it allowed them to invest their vast dollar reserves in a stable asset. Second, it gave them leverage in their economic relationships with the U.S., however. A combination of political tensions, economic shifts, and financial strategy changes has led both countries to rethink their reliance on U.S. Treasuries. China's strategy, reducing reliance on the U.S. dollar. China's decision to reduce its U.S. bond holdings is closely linked to its broader strategy of reducing dependency on the American financial system. The ongoing trade war between the U.S. and China, combined with restrictions on technology transfers and increasing geopolitical hostilities, has made Beijing more cautious about its economic ties with Washington. One of China's primary concerns has been the risk of financial weaponization. In the past, the U.S. has used its control over the dollar-based global financial system to impose economic sanctions on nations that oppose its policies. Beijing is wary of becoming overly vulnerable to such measures and has thus sought to diversify its reserves by investing in alternative assets like gold, the euro, and other international bonds. Moreover, China is pushing to strengthen the yuan's role in global trade and finance by reducing its reliance on U.S. Treasuries and increasing its international holdings in other currencies. China hopes to increase monetary independence and reduce exposure to potential U.S. financial pressures. Japan's motivations, domestic debt, and economic stability. While Japan is a long-standing U.S. ally, its economic landscape presents different challenges. Unlike China, Japan has not faced direct economic confrontations with Washington, but it has struggled with domestic financial issues, particularly high public debt and slow economic growth. For decades, the Bank of Japan maintained a policy of monetary easing, keeping interest rates low to stimulate the economy. However, global inflation pressures and exchange rate fluctuations have forced Japan to rethink this approach. As inflation concerns rise and the yen weakens, Japanese policymakers have had to consider strategies to strengthen their financial position. Selling off U.S. bonds has become one of these strategies. By reducing its U.S. Treasury holdings, Japan can free up capital to support its domestic economy and stabilize the yen. Additionally, selling off treasuries allows Japan to reallocate investments into areas that provide better returns in a changing financial environment. Coordinated move or coincidence? The 45% sell-off fact that Japan and China have both reduced their U.S. bond holdings at the same time has led to speculation about a possible coordinated effort. Given their historical and political differences, such cooperation may seem Unlikely. However, financial markets do not always follow political logic. One interpretation of the simultaneous bond sales is that both countries are responding to common economic pressures rather than acting in concert. The global economic environment, characterized by high inflation, shifting trade dynamics, and monetary policy adjustments, has created conditions where both Japan and China find it beneficial to reduce their U.S. Treasury holdings. On the other hand, there is also the possibility that both nations see this move as a way to send a message to Washington. If Japan and China believe that U.S. policies, whether trade restrictions, military alliances, or financial regulations, are unfavorable to their interests, selling off bonds could be a subtle but effective way to exert pressure. By reducing their holdings, they can create instability in the U.S. financial market, potentially forcing Washington to reconsider its policies. The impact on the U.S. economy: a large-scale sell-off of U.S. bonds by two of the largest foreign holders could have significant consequences for the American economy. U.S. Treasuries are widely traded, and their stability depends on consistent demand. If major players like Japan and China were to sell off massive amounts, bond prices would decline, causing interest rates to rise. Higher interest rates would make borrowing more expensive for the U.S. government, increasing the cost of servicing its debt. This in turn could lead to greater budget deficits and put additional pressure on the Federal Reserve to adjust its monetary policies. Additionally, if bond yields rise too quickly, it could trigger wider market disruptions. Stock markets may experience volatility. The cost of mortgages and business loans could increase, and the overall economic outlook could weaken. While some argue that other investors, such as European or Middle Eastern institutions, might step in to buy U.S. bonds, the immediate impact of such a sell-off could still create significant financial turbulence. Diplomatic and strategic responses. From Washington v. The potential risks. The U.S. government may take steps to counteract the impact of Japan and China's bond sell-offs. With Japan, diplomatic negotiations are likely to play a key role. The U.S. has a strong alliance with Japan, and Washington could use its political leverage to encourage Tokyo to slow down its divestment of treasuries. With China, however, the situation is more complex. U.S.-China relations have been tense for years, and financial negotiations are unlikely to be as straightforward. However, Beijing also faces risks if it sells off too many U.S. bonds too quickly. A rapid decline in bond prices could devalue the remaining bonds China holds, resulting in financial losses for Beijing itself. This creates a paradox. China wants to reduce its exposure to U.S. debt, but cannot afford to destabilize the system too much. The future of the global financial systems. Recent developments surrounding Japan and China's Treasury sell-offs raise broader questions about the future of global finance. Will other countries follow their lead and start reducing their dependence on U.S. bonds? Could this mark the beginning of a shift away from the dollar as the dominant reserve currency? While the U.S. dollar remains the world's most trusted currency, ongoing changes in international trade and finance could gradually challenge its dominance. Countries seeking to reduce their exposure to U.S. policies may continue diversifying their reserves, leading to a more multipolar financial system. At the same time, the U.S. government must carefully manage its debt and fiscal policies to maintain investor confidence. If major foreign bondholders continue to sell off U.S. treasuries, Washington may have to implement new strategies to ensure financial stability. Whether through economic diplomacy, changes in monetary policy, or adjustments to trade agreements. Conclusion: a global financial shift in motion. Japan and China's massive sell-off of U.S. bonds has raised concerns about the stability of the global financial system. While the exact motivations behind their actions may differ, the impact is clear. Markets are watching closely, and the U.S. economy faces potential risks. Whether this is the beginning of a larger financial shift or a temporary adjustment remains to be seen. However, one thing is certain: The long-standing financial order is being tested, and the world must be prepared for possible changes in the balance of economic power.